All right. What is going on, everybody? Good morning. Can everybody hear me? Can everybody hear me? Just type in one in the comment section if my voice sounds good to all of you. All right, Ken, we're live. Let's get you unmuted. Let's get you on the camera.
Yep. Just need you on to green light my video.
I'm sorry?
I said it's saying, host, you've disabled my video.
Oh, okay. Give me a sec. Let me just get you on. Here, I'll make you the host. And then you should be able to now turn on your video.
Yep, there we go.
There you go. How's it going?
Good. How you doing, man?
Not bad. Did you like that intro that I created?
Yeah, it's cool.
Just for you.
Oh, I feel so special, Tom. Thanks.
Awesome. Well, Ken, let's just get into it. Thank you so much for joining us this morning. Where are you based out of right now?
I'm currently in Florida. Originally, I live in Boston, but about 2 weeks ago, I decided to throw my 4 kids and wife into rented RV and drive 25 hours straight down to Florida to kind of ride this out in some sunshine and outdoor activities for the kids. So
yeah, if you're gonna, if I ever have to do this all over again, let's say 15, 20 years down the road, there's another virus and we all have to quarantine again. I think there's definitely some things I'll do a little bit differently. I think I go on some sort of an island and just quarantine in a big house instead of locked in a condo in Vancouver. I mean, it's not bad. But,
yeah. No, and it just at the end of the day, as long as everybody's safe, that's what matters, right? So
yeah, absolutely.
But yeah, it's been a nice change of pace.
Awesome. So we got a lot of people here this morning. So we got Antonio. This guy is from all the way from Brazil. Hope you're doing well, Antonio.
Nice.
Got Adam, Mahavrish, Vladimir, David, Marcus, Anita, Angus, Olga. So, hey, welcome everybody. It's a beautiful day out here in Vancouver, and I'm super excited to do this live interview with my friend Ken here. So, Ken, let's just jump right into it. For those that maybe don't know what Thrasio does, so talk to us a little bit about your background and talk to us a little bit about what does Thrasio do.
Yeah. So my background is prior to joining the Amazon ecosystem, I spent 12 years on Wall Street as an investment manager. So I was a stock analyst and portfolio manager, managing hundreds of billions of dollars in mutual funds. Really learned all about businesses, different business structures, financials, forecasting, modeling, etc. And then I got kind of, to be honest with you, Tom, I got burned out on that. Super stressful, particularly having gone through the previous downturn in 2008, 2009, and was really looking for something where I had more control over the outcome of what I was doing. I was started a family, had a lot more responsibilities, house, etc. And just wanted the feeling of empowerment day to day, knowing that I could enact change and it'll hopefully affect the outcome. So I basically pivoted to the startup ecosystem, and I actually got connected with an entrepreneur in Boston that had a couple businesses, one of which was a $15 million a year Amazon wholesale business through a mutual friend. He was looking for someone to come on and run that. So we had a team of buyers. We had relationships with probably 500 name brand apparel, footwear, accessory companies. And it was similar to what I was doing before. It was just allocating capital across different brands and products, trying to find gaps in the marketplace for supply, and just really focusing on inventory turns, return on investment. So did that for about 2 years, and then started to look around, and I actually got connected with one of our co-founders at Thrasio, Carlos Cashman in Boston. So Carlos he's built and sold probably 5 or 6 businesses in software. His most recent of which was one of the top Facebook ad agencies. So he partnered up with our other CEO, Josh Silverstein in New York. Josh's background is venture capital. And then more recently, he was kind of had a lot of boards and operational roles. And they were originally going to roll up direct-to-consumer businesses. So just, digitally native brands leverage Carlos's SEO experience and bench strength, and then Josh's ability to kind of raise capital and manage capital, etc. And then, as fate would have it, Josh actually helped Viral launch with a seed round, and he became the advisor to Casey there, and he actually was chairman of the board for a stint at Viral launch, and that really opened his eyes on the power of the FBA platform. And so they pivoted from the digitally native to Amazon FBA, made the first acquisition in the summer of 2018. So I think formally it was maybe June, was the first acquisition. Then they raised a few $1 million of equity, and then probably $8 million of debt. I decided to build out the team and really make a run at it. So I joined in November of 18 to run acquisitions on the front end of the kind of tip of the spear. And it's been an amazing ride since then. Just to give you a sense of perspective. So when I joined in November, I was the 8th person in the company. We had acquired 3 businesses, and total capital in the business was around 10 million. Fast forward to today, we have over 200 people globally in the company. We've acquired over 45 businesses, and we've raised collectively over $250 million of capital to invest in Amazon FBA businesses. So it's been pretty awesome, and it's amazing. It seems so long ago. I'm sure you can attest when you're moving at 100 miles an hour all day long. It's the days seem like months at times. We're so focused on what we're doing and think this is a massive opportunity. And I think we're still in the second, third innings of the company, which is pretty awesome.
Yeah, that's amazing, man. So no, it's super impressive of what you guys have done, and I know there's some other people out there that have tried or trying to do similar stuff as you, and I don't think I've heard of a couple of companies that didn't do too well. But for those who are on the call right now that are a little bit confused about like what Thrasio, because you're throwing these big numbers out there, right? You're saying terms like venture capital. You're saying things like raising millions and millions of dollars. If you can dumb this down, if you can explain to one of how old is your youngest kid?
Almost 2.
Almost.
So maybe
okay.
not him, but maybe my 5-year-old. Yeah.
If you can explain this to a 5-year-old, what you do, for the audience, so they can really familiarize themselves with the business.
Yeah. So, I mean, in simplest terms, we buy Amazon native private label brands and we operate them. So, I mean, it's pretty simple. So, there's over 30,000 brands doing over $1 million a year in revenue on Amazon. That's kind of our target market. And we acquire them, we stabilize them over a migration period. And that's really kind of checks and balances that we do once we take over the brand. And then we seek for avenues of growth. So it could be exploiting, marketing inefficiencies on the Amazon platform, but it could also be looking to take products into physical brick and mortar locations here in the US, really ramping up D2C investment, product line extensions, etc.
Right. Awesome. So Ken, actually, I've noticed something when I'm speaking, actually it's better now. I hear an echo from your end. It might be because my when I'm talking, it's coming out of your speakers.
It's not. I just have.
It's coming out of your iPod?
Yeah, I just have AirPods on.
Oh, weird. Okay. I hear a little bit of echo, but should be fine. Okay. So let's talk a little bit about your criteria then, because if your business is essentially focused on acquiring these businesses, and in order for you to grow, you need to not only acquire more businesses, but also obviously when you acquire them, you got to make those businesses grow. So we'll tackle that a little bit. But when it comes to your criteria of a perfect Amazon business for you to just like, I want this so bad right now. I've heard a few podcasts of you basically talking about that, but can you share a little bit about your specific criteria of what you guys look for? What is your thesis in this massive world of Amazon FBA?
Yeah. So what we look for, there's a couple high level criteria. One is, revenue. It's actually a pretty wide range now. So annualized revenue anywhere from 1 to 40 million. And then within the actual products themselves, we're category agnostic. So we actually have more, I would say, disqualifiers than qualifiers. So we look across the board, for home and kitchen, sports and outdoors, pets, auto, et cetera. We're not consolidating within a certain segment, trying to gain scales of economy that way. We're building a portfolio of industry leading products, is how we look at it. So there's certain things that we don't necessarily um, look for, and one is high technological obsolescence risk is something that we shy away from. So if it's fast iteration cycles and product development cycles, or even form factors, we haven't done a lot there. So if you think of screen protectors or stuff that's tied to the iPhone, kind of new releases cycle, high frequency cadence of new releases, we try and stay away from. Supplements is a space there's a lot of businesses for sale in the supplement space that we've come across over the past almost 2 years. We haven't done anything there yet. We can get into reasons behind that, but that's something we shy away from. And then anything that goes in the body in general, kind of been hesitant. But other than that, we really look for industry leaders, so category leaders. Do you have the reviews, the review quantity, the product rating, to kind of sustain a top 5, top 10 in the marketplace on Amazon? That's really what we look for. You'd be pretty surprised if you actually looked at our portfolio, and how disparate a lot of these businesses are to one another.
Right. And I remember you were saying that the perfect product for you would be like a spatula, like a spatula that is that has the most
Yeah.
number of reviews. And the reason
Yeah.
behind that is because
10,000 reviews. Yeah.
right, it's because like no one's ever gonna kind of create another product that is gonna be better than a spatula. And for the listeners out there, one of the things what he's saying is that he doesn't like to find products where, for iPhone cases, every single year there's a new iPhone case. He likes to find a product that's been around for the past 20 years, 30 years. And this particular product on Amazon has the most amount of reviews, and it's probably going to be around for another 20, 30 years. So that's something that they look for.
Yep. Yeah. And that's a great point. So we call it evergreen demand. So not, something that doesn't have it's a fad or a quick product life cycle, just steady everyday use. There's a somewhat of a natural replacement cycle to the products. And that's the beauty of Amazon. I mean, we're looking for kind of that beachfront real estate, right? It's the equivalent of being in a grocery store at eye level, right in the middle of the shelf, right? I mean, that's what you're trying to build as sellers on Amazon. You're trying to build those listings up to become that beachfront real estate on Amazon, and that's what we look for. And I think that's the beauty of Amazon in my mind, is that everybody in today's day and age is just on decision overload. I mean, I can't tell you how many decisions I have to make in a day, right? I mean, so then when you add on the exponent of children and all things you got to do for them, it's crazy. And I think that's the simplicity and beauty of Amazon, is it actually takes a lot of those decisions away from you, and makes them for you in the way that they represent the brands. It's this social proof of, hey, all right, 10,000 people rated this 4.5 stars. It's a great price. I'll do it. Right. I mean,
Right.
you see the statistics, 90% of people don't scroll past page 1, and probably close to 60% of the volumes in the first kind of five listings on any given page. So, that's kind of what we look for. So the products that have built up that review and rating mode.
Yeah, no, totally. So I'm curious to know, if you acquired 43 businesses so far, just a ballpark, how many businesses have you actually looked at in total?
Over 400
Over 400.
plus.
So about 10%
Yep.
closing rate.
Yep.
Which is
and part
pretty
of that,
high, no?
go ahead. Yeah, it is. So I would say, one, it is high. And then 2 is a lot of the businesses that come up are just, they either proactively reach out, or we've found them through brokers, et cetera. So they've kind of been in that sweet spot. And what's crazy is our second derivative of growth is accelerating. So every quarter we're acquiring more and more businesses and more kind of revenue and profit and EBITDA.
Right.
So
right. So talk to us a little bit about maybe some of the trends. Well, actually, before even that, if you look
Yeah.
at a lot of these businesses, let's say you looked at 400 businesses, what would you say that the most common mistake, because a lot of my viewers right now, and I want to really, provide them with a lot of value. Um,
Yeah.
they're all Amazon business owners, or they want to be Amazon business owner one day. And some of them are just starting out, but some of them have really successful Amazon businesses. What are some of the most common like mistakes that you've seen brand makers or Amazon businesses making when you're going through these? You're just like, oh my God, like only if you fix that one small issue, like your
Yeah.
business will be
Yeah.
worth
Yeah.
so much more. Like, what would that be?
So hands down, the biggest one is investing in creative content, um, particularly photos and video. Um, I can't tell you. I think we have a first class creative team within Thrasio. So we have photographers, videographers, content writers, copywriters. We have all that in house on staff. And I can't tell you the number of times where we've invested, $10,000, $15,000 all in on completely redoing a creative, and you can double conversion rates.
Wow.
Um, and I look at listings and people have stuff photoshopped. The leg is, the shin is 5 feet long for like a massage, or it's just like this is it particularly right. It's when you look at the based on the price point, and you have to put yourself in the eyes of the consumer. Again, like this massager I was looking at, it was a $250 $300 calf and foot massager, and the photographs were all photoshopped.
Right.
And if I'm a consumer, and I'm going to do a lot more research when I'm spending that kind of money on a product, and I go and I see everything's photoshopped, it doesn't scream quality, right? So I think I understand that people are bootstrapped, and they're every dollar out the door really needs to count, and it's something that it's a leap of faith to invest in that, because you're not going to see the immediate return versus buying inventory and being able to turn it. But I think that's the one piece of advice that I always tell sellers is, you should have the best looking photos in your market segment, because it can do wonders for your conversion rates. I mean, it
Yeah.
really can. We've seen it firsthand numerous times.
Yeah, absolutely. What are some of the operational mistakes that you see? So that's like the cosmetics, right? Like the lipsticks. But what about some, like if you dig deeper into the numbers, what are some of the
Yeah.
operational things that these guys are not doing well within their business?
Yeah, I think one of the biggest is diversifying too quickly across products. So, I'm a huge believer in riding your winners, and that's something I learned when I was investing.
Mm,
I would manage a portfolio of stocks, and maybe it was 50 to 80 stocks, and you always had it. You look back at the end of the year, and there was probably a handful of stocks that really drove the performance for the entire portfolio. And
right.
that's true with an Amazon business, right? I think people are too quick to establish your hero product, and then you just get nervous. What if it gets shut down? What if it gets attacked? I have so much risk concentrated on this one product, that they start to like launch new products, and they test things, and you wake up 12 months later, and you have 30, 40, 50 products, and that one product is still driving 80% of your revenue. But you've probably taken your eye off the ball on that product, and you never really fully maximize that potential. Particularly as it's getting more and more expensive to launch products on Amazon and pay to play, et cetera. So I think that's one thing that I've seen. You look at it, and they had such a great thing going, and then that product just kind of flattened out,
Mm,
and they had stuff coming up underneath it, but it never really equates to what the hero product could have been if they had
mm,
just really continued to double down on that one listing. And that could be right, just launch new variations, launch just different things on that
right.
hero. But uh, I would say that's one of the biggest operational, and secondarily behind that is diversifying off of Amazon too quickly.
Mm,
you know I you hear this all the time, and you got to get off Amazon. I mean, we're betting our business right now on Amazon, so we're firm believers in the marketplace and the platform. And particularly if you're a good actor in the ecosystem in the marketplace. But I use the term diversification versus diversification in regards to going off Amazon. You really need, it's totally different unit economics. Running a Shopify store versus an Amazon store, right? You got to contend with customer acquisition costs. So what does it cost to acquire customer, and then what's your lifetime value of that customer, and can you recoup that investment or through ads and the cost of acquiring a customer? Can you recoup that over time? And if you're a subscribe and save and you have a repeatable purchase pattern product, you definitely can. But for one hit product that's selling at $25, it's really hard to make the economics work direct. And we have our marketing team's incredible. They've come from large corporations managing multi-million-dollar monthly budgets of direct, so they know, and we'll look at products and say this would be great, but we just can't make the numbers work. So that's another one that I think it helps people sleep at night, and it gives them comfort just to know. But I always ask the question, okay, if Amazon shuts your listing down or your storefront down, is the 5% Shopify contribution going to save your business? The answer is no, right?
Right.
Even Walmart. I mean, we have a head of Walmart now internally, but every business of all the business I've looked at, I've yet to see a business generating more than 5 to 10% of revenue from Walmart. Sorry.
Oh.
Sorry. So
yeah, no problem. Good.
So I've just, it's an exercise in futility sometimes. So, and you got to make sure that your product actually lends itself to other marketplaces and the consumers, right? Like the Walmart consumer is totally different than the Amazon Prime customer. If you look at the demographics, I mean, I think the Prime, the average Prime customer household income is 90, or 75,000. Walmart's probably 35,000. So
interesting.
It's just different customer demographics, and I just don't see anybody over the next 3 to 5 years usurping Amazon's power here, at least in the United States, right?
Right.
From the consumer.
So here's the thing, right? It's like, you guys are obviously a group of very, very highly intellectual folks, and you guys calculate risk and reward very carefully. Now, a lot of people would say some things like, there's a huge risk of selling, of being 100% dependent on Amazon, right? You're platform dependent on Amazon. You have vicious competitors on Amazon. Amazon can even launch the same product as you and take you out. So Amazon Basics, etc. So I'm sure you've looked at all this. So what would you say to someone who's saying things like that? Like, what's your response to that?
Yeah, I would say, look, it's a valid argument, but you have to look at history, and you have to look at the big picture of what Amazon's been able to accomplish, right? I mean, you look at, if you just look at that metrics of third-party revenue and GMV on the platform, right? It's gone from 10 years ago was 0 when they were all 1P to now, 62, 63% of all GMV is through third-party sellers. It's third-party sellers are probably twice as profitable than first-party sellers to Amazon, right? Like, they don't have to put their capital at risk. They don't have to buy the inventory, et cetera. They still have to build out the same fulfillment centers if they're running 1P. So that cost is really the only kind of 3P cost, and they often are charging us for that, right? So if you start with the hypothesis that Amazon's marketplace is increasingly relying on third-party sellers, I think that's a positive, right? Secondarily, when you look at the overall e-commerce marketplace, particularly just here in the U.S., I mean, e-com's probably, I would say for stuff that Amazon sells, e-commerce is probably 25% penetrated. The statistics will tell you it's like 13, 15%, but you have autos in there and things like that are large, large absolute dollars within the retail market that just don't lend themselves to e-com. So if you just assume e-com's 25% of total retail volume in the U.S., Amazon's 60% of that, right? And right. A growing share. So, I mean, you look at those two factors, and I think that's what gives us comfort in the fact that, making a bet on Amazon. I mean, it is the largest e-commerce platform. So why wouldn't you want to be aligned to that? I know it's a little, you hear the horror stories and it happens, right? It's the same thing as you're running direct and you have a great campaign going, and then Google changes its algorithm, and it happened with Panda, and like tons of companies went out of business during all their algorithm changes too. So you're still susceptible to risk, right?
Mm-hmm.
It's just how do you plan for it? How can you mitigate it? And
Mm-hmm.
what contingency plans do you have when you're faced with it?
Yeah, totally. So have you kind of seen, what are some of the trends that you've seen in the marketplace since 2008 when you started? For example, have the valuations been higher? Have the sellers been more sophisticated? What are some of the trends that you've been seeing since 2008, since you started?
Yeah, I think, well, one is just general market awareness that you can sell your Amazon business. So, I think there was it was taboo before, and no one knew if you could do it. I mean, I still get questions about it all the time. It's like, are you sure you can do this? I'm like, yeah, well, we're doing it.
Yeah.
We have many proof points that it happens, that you're able to do it.
Yeah.
But I think, look, there's, in my opinion, I've seen a bifurcation of sellers that view Amazon as a get rich quick scheme, and it was, right. There was tremendous leverage in having first mover advantage in 2012, 13, 14, 15, right, when you could, buyer groups and review groups weren't against terms of service. Amazon kind of turned a blind eye to that to get more products on the marketplace and increase conversions and sell through. And then there was a big shift, I think since 2016, and the businesses that we're seeing, they're treated as not a moonlighting get rich quick scheme, but they're treated as a real business, right? I mean, these are people. This is their full-time job, is running an Amazon business. I mean, I talked to sellers that did 30 years in a corporate setting and either bought an Amazon business or launched it, and then they quit their job, and they know everything about the numbers, they know all the fees, etc., and they're treating it like a real business. So I think from that standpoint, that's probably been the biggest pleasant surprise from my perspective,
Mm-hmm.
is the amount of people that are growing at scale, and treating it like a real business. So they fully committed, and it's bears out in their numbers.
Right. So let me ask you this. Knowing the stuff that you know now, and having 2 years of experience doing your role and looking at over 400 businesses and actively running 43 of them and scaling them, if you had to start let's say you no longer work with Thrasio for whatever reason, and you were handed this like $1 million per year business, but then you had to double the valuation of that business within the next 12 to 24 months, and you have all these knowledge, all these different things. What are some of the things
Yeah.
that you would do to actually double the valuation, so that when you do sell in a year or 2 years, you can get a lot more for the business?
Yeah. So one is, right, advertising. You have to nail advertising right now. If you're an Amazon seller and you don't know every single acronym, managing living and breathing your campaigns, I think you're going to fall behind. It's becoming a pay to play marketplace, and will increasingly, right? I mean, it effectively is a zero incremental cost to Amazon to serve up more ads. So the margins on PPC for Amazon are tremendous, right? So I don't see that changing anytime soon. So to just hope that you can get by in organic, and who knows how your absolute advertising spend factors into the overall algorithm of your product portfolio and product placement. But I think that's the one thing that I would just hammer on, and maybe I would run at a little bit lower margin for a few 3-6 months, and really just focus on accelerating top line growth. And then because if you have a high conversion rate, it makes sense to just jam advertising.
Mm-hmm.
much as you can kind of withstand, because then you'll start to get ranked more on different keywords, etc. And you'll just start getting served. It just becomes a self-fulfilling prophecy. And I think people, it's one mistake I think some people make, is they focus just so much on the margin, when it's like you can give up, $1 profit to make 1.5, 6 months from now, 9 months from now.
Right.
So it's hard to do though when you're bootstrapped, you're cash strapped. But that's one of the things that we're able to do with our huge capital base, is really make those investments. If you lose a bestseller tag, we can run at break even for 2 months, 3 months to recapture it. Right. Some people don't have the luxury of doing that, but I think that's probably the biggest. And then secondarily, it would be, again, investing in the creative, particularly when I'm looking at businesses, right? I think we're a little bit of a different, unique buyer, in that we have a team, right? We have, like I said, over 200 people globally running and managing these brands, and investing time and resources, from in-house attorneys, IP attorneys, to photographers, to supply chain analysts, etc. Now your entrepreneur is not going to have access to all these resources, so it's really return on time and money is important. So I would invest in the best photography that I could get. It's just, people just don't do the math on increasing conversion rate by 20%. And it doesn't take that much to do. I mean, people would really be surprised. We use PicFu all the time, like they're great. So I would definitely make sure I have the best quality content relative to the competition, as
totally.
well. And then you can do the new product launches. It's just Amazon changes can change so rapidly that it's hard to say, like, oh, this product can be 5x from now. You just never know what's going to happen.
Totally. So love to kind of understand a little bit more, and I'm going to ask some questions with regards to Thrasio's business model. Love to just dive a little bit deeper. I find it to be a fascinating business. So this obviously has not a whole lot to do with Amazon FBA. It's more of a business talk. And of course, you're as comfortable as you're as you're willing to share. So for those that are not too familiar, and it's funny because I came across this, I would say roughly 6 months ago, when I finally understood. Well, first of all, I was exposed to this notion of you can buy Amazon businesses at 2 to 3x valuation EBITDA, right? So if your business, let's say last year did $1 million in net profit, Ken or someone else might be willing to buy your business anywhere between, let's say, 2 to 4x. So you get $2 million to $4 million cash. But on the other side, Thrasio has acquired this asset, has acquired this business, but then they are being valued. So Thrasio is being valued at 20x, 30x, 40x, or whatever it might be. So there's a stock in Canada that has done really well over the past for a long time now, and they're the Boyd Auto Group, right? They're Boyd Auto Group. What they do is they're auto body shops. So what they will do is they're publicly traded. I think they're traded at like 9x EBITDA right now or something like that. But what they will do is they will literally just go around small towns and they'll acquire all these mom and pops auto shops, and they will just plug them into this public vehicle. And then every single acquisition they make that margin between like 2x to 7x or 9x. So is that really like that's the whole strategy of roll-ups, right? You acquire these assets at a lower multiple, and then you can one day sell them for a higher multiple. Is that kind of the play that Thrasio is doing, or can you talk a little bit more about that?
Yeah. So I mean, that is the general thesis of roll-ups, is that, but there's also scale economies. So it really depends on the business model, but the other side of it is because of this operating system that you've instilled, you can run these businesses much more efficiently and more profitably.
Right.
So over time, your cash flow yield actually increases on the business,
Mm.
and the effective multiple that you paid actually comes down over time. So that then you just create more equity value. And for a lot of like the public company roll ups, that's what they use, right? So um, they might be, if they're using stock particularly to acquire these businesses, is even that much more um, impactful. But if you use debt, right? So let's just say, kind of round numbers, if you're acquiring a business at 3 times cash flow, which you got to think, if the businesses are growing, yes, people are buying it for 2 to 3 times EBITDA, but it's really probably 3 to 4 times cash flow, because you are investing in working capital and inventory. But let's just say it's 3 times. That's a 33% cash flow yield. So if you can finance that acquisition at 8 to 10% or even 12%, you're still capturing that spread to the equity holder of 20% return on equity. So, yeah, what we're doing is, we originally started it just like, let's just see where this could go, right? But I think what's really interesting is what we're seeing is a lot of these brands have the opportunity to actually create a lot of brand equity on their own. So they're not just products, they're not just listings, but they're actual brands, right? And you can build a brand around that product, and so we're kind of building a next generation consumer product good company that uses M&A as our R&D engine. So, not all the products that we're buying and all the brands are going to lend themselves to going off Amazon, but there's a good majority of them that will. And, again, you look at, some of these brands like Harry's, the digitally native brands, the ones that are really successful are the ones that actually make the pivot from digital to brick and mortar. And it's just, you can get massive distribution leverage. So that's kind of what I think, we think there's an opportunity to consolidate a couple $100 million, 500 million plus of revenue over the next few years. And then we'll kind of see what happens from there. But we're building a company that is, again, we believe is a next generation CPG company. When you look at supply chain, for instance, right? I mean, I think our team is probably, if you factor in our analyst team, over 30 people just in supply chain.
Oh, wow.
Marketing and advertising is probably 20 people. We're hiring influencers, we're testing licensing. We're doing a lot of things that a typical Amazon just private label product wouldn't do, but that bigger brands do. So we have like a percussive massage gun. We've got like Tiki Barber is endorsing that. We're testing endorsements and things like that. So, but there's a lot of advantages to, if you think about, one of the beauties of roll-ups is, if everything's on the same system, when you make a little tweak to that system, you're able to create exponential leverage, right? So, for instance, if we figured out how to crack DSP or something like that, and only 3 of our brands have it, and we can now roll it out to 45 other brands in our portfolio, right? And we get a 15% revenue lift across the entire portfolio. It's things like that the roll-ups underneath the covers is really where you add tremendous value. So for again, as an entrepreneur, if you do a tweak to your business and you're like, oh wow, I just gained 1 whole percentage point of profit, 100 basis points of profit just from doing that tweak. Yeah, it's great if it's a nice win if you're doing $1 million and $1 million in revenue. That's an extra $10,000 in profit. But think about that scale when you're doing 250 million in revenue, 500 million in revenue, right? And that's real dollars. And that's really what's super interesting about, I think, roll-ups. It's just everything from consolidating container shipments, right? That if it was a standalone business you couldn't do. So you have to really think through what are the economies of scale. And a lot of times for, the Boyd Auto, it's a lot of back office stuff. It's billing, it's software, a
Mm.
lot of this, scheduling, parts buying, like having scale leverage.
So let's say hypothetically speaking, I want to do a mini version of Thrasio. So I want to acquire some
Yeah.
Amazon businesses myself that are obviously not doing between 1 to 4 million, but maybe $100,000 to $400,000 or something like that.
Yeah.
I want to start this. So obviously, in order for me to actually acquire these businesses, I need money. What is the best way to, if we're talking specifically about a mini version of Thrasio, of me as the
Yeah.
operator, what is the what is the best way for me to actually raise capital? Would it be to sell people this vision so they can actually invest in my company as equity owners, or is it better to actually raise debt, or what are some of the ways for me to raise money for this specific business model?
Yeah. I mean, we've done it. The majority of our capital up until this recent raise, though, was on debt. So a lot of it has to do with your confidence and your ability to run the businesses, to be honest with you.
Mm-hmm.
Right. And who do you want to answer to investors or not?
Right.
I think that's, one or two of our competitors, I think, did actual venture equity in the beginning. And then, if you got to be able to withstand, I mean, I would say, I like to joke around, but it's true. I mean, to some extent, like our first 5 acquisitions were our worst 5 acquisitions, right?
Mm.
So learning what to do, what not to do, how everything comes together, the transferring of the accounts, there's going to be gaps in inventory ordering. You got to reset campaigns if you switch Seller Central, like all that stuff that we didn't know, right?
Right.
Now there's tremendous value in going through that, but if we didn't have the capital or the fortitude to continue with the bigger picture in mind, you could see why someone just be like, like I don't, this isn't
Mm.
worth it. I
Sure.
don't know what I'm doing. This is making me nervous, etc. But yeah, I would say, look, there's still a lot of capital that's on the sidelines looking for a good home. I mean, you look at interest rates here in the U.S. Nobody's really earning money, just having it parked somewhere.
Mm.
The equity markets are, coming back, but there's still a lot of error in valuations in the public markets. So there's a lot of sidelines in private equity and venture capital looking to, bet on companies. I mean, there's a company in Boston, Toast, that, just got valued at $5 billion a couple months ago, and they cater to the restaurant industry. Sadly, they had
Oh
to
no.
lay off almost 60% of their staff, right? So I assume the valuations following that similar path. So it's just, I mean, there's no better like platform and opportunity in my mind, than kind of Amazon right now. When you look through, stocks at all-time highs today. There, if anything, this, kind of pandemic has shown that, everything from the cloud, AWS, to right, like connected cloud, their distribution network, everything. I mean, the video, it's kind of been a perfect, storm for Amazon in this environment. And I think e-com in general is accelerating through this, right? I mean, we've seen tremendous growth in a lot of our brands during this time period, and I think you're getting a lot of consumers that were hesitant to move online and that have now been forced to. I'm thinking older generation, right? That don't have a choice now,
Mm-hmm.
and maybe their kids are setting up Amazon accounts for them or getting online groceries delivered if they're
Right.
in their 60s or 70s, high risk population. So I think you had this gradual adoption of e-commerce that was accelerating, and I think it's probably hitting an exponential curve right now. And I don't see people resuming weekly trips to the malls, and I think it's just going to continue to accelerate. So I think investors and people with capital are going to be looking to figure out how to gain the best exposure to this. And you can go out and you can participate in the public markets, or you can look in the private markets. And I think for my money, I mean, I've looked at D2C brands, I've gotten pitch brands, and they're 5 to 10 times EBITDA, depending on the brand. No, not to say they're not worth it, but it's never been easier to start a D2C brand. So I think that even on that side, that people talk about the competition on Amazon, but there's tons of competition outside of Amazon.
Yeah.
I mean, I get served new brands every day on Instagram and Facebook, and
Yeah.
So
Yeah.
I think, yeah, I would I think, I would suggest if you're a seller, maybe you buy a small one, like try and buy the smallest one you can to like actually go through the process.
Yeah.
Totally. So of like the legal process, the asset purchase agreement, like transferring the account over, like you're gonna mess up, right?
Yeah. Yeah.
But keep the end in mind, and you try and minimize the impact of your mistakes early on. So
Yeah.
I would, don't go big your first acquisition. I would try and do some smaller ones, and really just, and probably honestly do it with like a broker, through an Empire Flippers, Quiet Light. Do one of those smaller deals that they can hold your hand. They'll put the financials together. And that's one of the really interesting things too for us that allows us to move so quickly. I mean, we're typically turning the first draft of the asset purchase agreement within 20 days of signing the letter of intent, because it's the same systems over and over again that we're diligent the financials out of Seller Central, right? So we can, we have a script, we can build a P&L basically within an hour. Our diligence team is incredible. So we pretty much know these are the financials, these are the profits that we're buying. And if you were doing that, like in the Boyd, you have QuickBooks, maybe they have, they're keeping Excel, they're classifying expenses differently. You got to really take the time to dig through that. And that's one of the beauties within Amazon. There's one canonical source of data in Seller Central.
Right.
So it really gives us confidence to move quickly through at least the financial aspect of diligence.
Right. Cool. Awesome. Yeah, no, it's something that's it's quite interesting to me, just understanding that there's a business where people can acquire businesses for 2x, and the second that they acquire the business, they can acquire the business using this vehicle, and now all of a sudden it's now valued at 9x. There's a guy named I mean, it's not as easy as that sounds, but that's kind of the general scope of things. It's like not automatically make too much. But there's a guy here in BC. His name is what's his name? Jim Pattison. Have you heard of him?
No.
Jim Pattison. Yeah, that's how he's a billionaire out of British Columbia, and he formed a conglomerate here in Canada. He has his hands everywhere, right? Grocery stores to signage to whatever.
Oh,
and
nice.
I'm reading his autobiography right now, and it's just him starting up as a nobody, and he's using debt and going to RBC to get $1 million of line of credit and doing takeovers and stuff like that. So I think especially for me, like I'm first generation like immigrant. My parents in China has always taught me like debt is bad. Like whatever you do not go in debt. Do not use that. Do not I've been. It's the way that I've been shaped. But now I talk to people like you, talk to people like reading books. Like everybody's like, no, like you should use that. Obviously, use it smartly. Don't be an idiot and blow it.
Yeah, of course.
But it's leverage, right? It's like you can do what you want to do, but you can do it so much faster and bigger. So it's interesting.
Yeah, and I mean, look, it cuts. To your parents' credit, right? It can cut both ways. I mean, you look at the housing crisis that the U.S. went through, and that's what happened. I mean, it's great because your return on equity can be tremendous, right? So if you were putting no money down and you saw your home value rising by 20% every year for 3-4 years, right? I mean, buy $100,000 home, you don't put anything down, you finance it all with interest only. You're just paying on the debt, and then you sell it for $200,000. I mean, you just made a tremendous return on equity because you put nothing down. You basically made $100,000. I mean,
Right.
It's crazy, right? You just got to have confidence in the investment of what you're levering up to, and the exposure of the cash flows, and confidence that the cash flows will continue, right? To
Right.
service,
Right.
as long as you service the debt. I mean, that's the beauty too of the Amazon. It's you know as long as the interest rates attractive enough, and you have your confidence in your ability to grow the businesses or even keep them flat, it's still a pretty attractive
Hmm.
economic endeavor. It's when you get shut down and then you're shit out of luck, right? I mean, so you gotta hedge that risk and account for it. And that's why the multiples are where, I mean, look, there's still a lot that can go wrong, and we've had stuff go wrong, and we've had stuff go sideways on us, and it's just part of it, right? But we also are taking a portfolio approach, so it's kind of overall the portfolio is up and to the right at a very nice clip.
Totally. Cool. So Ken, look, I appreciate your time. It's always cool chatting with you. Some people that are very, very, come from a different background and kind of dabble in the Amazon space. So I think you guys bring like a very different approach to things, and it's cool to understand your thesis and kind of where you guys are going. And I've been thinking about kind of, because I have a bunch of students, I have a community,
Yeah,
and I have like, I'm pretty sure I can get some deal flow if I wanted to.
yeah,
Whether they're good deals or bad deals, that's a different story. But I thought about kind of like, oh, like what if we acquired, because my brand, so it's like, what if
yeah,
we acquired another beauty brand and see if we can actually grow that way instead of keep launching new products. You know what I mean?
yeah.
So
You
it's
sure?
interesting.
Yeah.
Yeah.
I mean,
Um.
look,
Yeah.
you got to just weigh, right? Is it like you do the math? Like, what would it cost you to replicate the revenue and profitability, right? And it's really like a capital allocation decision.
Hmm. Hmm.
Like, do you go out? I mean, it's great if you get finance of the debt, but you got to say, hey, all right, if I wanted to build a brand from scratch and get to $1 million in revenue and $200,000 in profit, annual profit, how long would it take me, and how much money would I have to invest to do that? You know, um, so there's always trade offs.
Yeah, totally. So let's answer some questions, and then we'll just wrap it
Yeah,
up.
sure,
Okay. So
absolutely.
Antonio's got two questions. So this is the guy from Brazil, by the way. So I
Yeah.
know him well. He came to Vancouver for Ecom Hub Summit 2 years ago, and great
Oh,
guy, great
cool.
guy. So two questions. First question is, what's the usual account transfer process? Do you acquire the actual underlying company and all the assets, or just the listings and the account?
Yeah, so it's a great question. Depending on the geography and where the assets are domiciled and held, the deals are typically structured as an asset purchase. So we effectively buy all the assets that are required to run the business. So that would be your trademarks, your seller central account, all your social media accounts, et cetera. Anything that is required to run the business. We don't buy your computers and warehouse if you have your own warehouse, things like that, employees, et cetera. So it's really everything that's focused on running the brand itself. If you're in the UK or Germany, those are typically structured as share purchases. So in that event, just because it's so much more advantageous to the seller from a tax treatment standpoint, those are equity share purchases. So we're buying the whole company, the liabilities, et cetera. So that's also what allows us to move so quickly through diligence. Is we don't assume any prior liabilities because we're just buying the assets. We're not
Right.
buying the whole company. Yeah.
Right. Cool. And how does international presence and other marketplaces impact your will to invest company's valuation?
Yeah. I mean, it's a factor, right? We sell in pretty much all of the marketplaces outside of, I think, Japan, India, um, maybe one other, maybe UAE. I don't know if we're in there yet. Um, but we've bought exclusively pan EU businesses. We've bought businesses that are just selling on the UK market. So for us, it's definitely a call option on growth, and we would make the decision on whether or not it makes financial sense for us to launch in new marketplaces. One thing we've kind of it's been bubbling under the surface, right, is kind of the one listing, unified listing. So that could be a big opportunity down the road for sellers that have really strong review modes. So we look at it. I wouldn't say it's a massive. It's not going to sway us one way or another, whether or not to do a deal.
Mm-hmm.
But it's something we take into account if they just launched or they got early traction. We definitely would take that into account.
Got it. Cool. Actually, he has one more question, right? Quick. I think this is a quick one. How should a prospect seller set up their account, brand or listing structure to make the transition as smooth as possible in case of an exit? What factors have bottlenecked the transition before?
So the biggest is just the bottlenecks that we've run into is we have the ability just to buy one brand. So we've had sellers that have had 5 or 6 brands in one Seller Central account, and they maybe only want to sell 1 or 2 brands to us. So I would say if you are in that position, and Amazon's now I saw eased restrictions on having multiple accounts, so it would make sense to, if you were going down that path, maybe just set up, if you're going to sell it all together, it's totally fine. But in the event that you own multiple brands, and you only maybe want to sell 1 or 2, maybe put those in your own Seller Central account, transfer the ASINs. But in terms of setting it up, yeah, I would just say, have a streamlined operating structure. Some buyers, this doesn't pertain to us, but some buyers, if it's another entrepreneur that's looking to buy their first Amazon business, which there are people out there doing that, having just clean financials in terms of credit card, bank account, just strictly for your Amazon business, not commingled with other things like Tom.
Right.
You might have consulting fees or your other business or
Right.
things like that, that somebody has to parse through.
Right.
So you just want to make it clean, as clean as possible.
So it's possible to do ASIN transfers, right?
Yep.
Is it a pretty tedious
yeah.
process, or is it pretty straightforward?
It's pretty straightforward. It's just time consuming. So you basically, we have to start shipping inventory in to Amazon, attach to the listing, run your inventory down, and then transfer the ASIN over.
Okay.
So it just takes a little bit longer, and it's just a little bit more work on the back end versus just transferring over the Seller Central account. Yeah.
Got it. So Mark has a good question. Have any of their acquisitions not worked out well? And if so, what have they learned from those?
Yeah. So like I said, I kind of first 5 or worst 5, I like to say. I think the biggest learning was just knowing where products are at, within their category and the category life cycle. Like I think there's these, whether it be due to Instagram or what have you, these products that kind of fly too close to the sun too quickly. And you don't know if they're a fad or, they might serve a functional purpose, but it's just like they fly so close to the sun, they don't have a lot of differentiation. And then that just lends itself to competition, whether it be directly from Chinese suppliers, et cetera, coming into the market. So, being weary of the true hockey stick growth curves. So one of our early acquisitions, I mean, it was crazy. They went from, predated me, but they went from, I would say, like $100,000 in year 1 to like almost $1 million to like $4.5 million in revenue in like 3 years. And we kind of bought at like the peak of their product growth rate. The category still continued to grow, but they went from a place of playing offense to defense very quickly, and we didn't know how to play defense at that point in time. So it's something that we've got, obviously, had to have got good at, because a lot of the products that we are buying are leaders. So you're inherently playing offense and defense versus just attacking. So that's probably one of the biggest things. And then I would say, yeah, the other thing is it has to relate also to nascent markets, where you really have to stay on top of the competition and what the competition is doing from a creative and presenting the product standpoint, right? So you might, if you're not staying on top of the competition and monitoring it daily. We had a few instances of, not the whole brand, but a few products here and there where they were leaders, and we kind of got caught off guard when everybody's adding this to their photos, and we were late to do that, or they're like starting to do giveaways or like things like that. But yeah, like we know that not all brands are going to be acquisitions are going to be home runs, and we don't expect them all to. And we kind of price accordingly, knowing that things can and will go wrong over time. But all in all, it's been a great experience buying Amazon businesses, and
Oh,
yeah.
oh, you got cut off there for a second, but it's all good. You're back
Oh,
now.
sorry.
Yeah.
Same. But I mean, that's I have the best job, I think, in the company, just talking to the sellers, learning the stories, and then following up with them and showing them the changes, that we're making to the products, and they still talk to the brand managers post acquisition, and lend their advice and cool product ideas or what have you.
Right.
So
You guys acquire
really
most.
cool.
You guys acquire most businesses outright, right? 100%, right?
Yeah, we've been toying with kind of an investment. We just yet to land on a structure, so I think it's something that through the second half of this year we'll try and refine a little bit.
Right. Okay.
But yeah, for the most part, we just acquire them outright.
Got it. Okay, guys, there's a lot of questions, so I'm just gonna pick and choose what I think is the best ones. So if I don't pick yours, please do not be offended. But we just don't have that much more time left. But let's say Adam asks, running down the income statement, do you have a rule? Do you have a rule for gross margin ranges, percentage of ad spend, percentage of Apex, etc.?
Yeah, so I would say in general, most businesses that we've looked at run at anywhere from 18 to 25% net margins. In terms of ad spend, percentage of revenue, that range is probably, I would say, 7 to 10%, is a pretty healthy range. And then those margins, we roll fees into it, the Amazon fees into our calculation of gross margin. So it's probably a little bit of a definitional mismatch, but I would say if you're just doing straight COGS, COGS are anywhere from 20 to 30% of revenue.
Mm-hmm, mm-hmm. I like this question, but I like this question by Adam as well. What are the core functions of your team? For example, if you can build a mini Thrasio, 3 to 4 acquisitions, what would you recommend? What would your recommendation be for headcount and functional structure?
Yeah. So what's interesting is that a lot of it has to do with how many products, right? Like overhead, for management capabilities. So, but the functional would definitely be marketing and advertising, supply chain, and then we have just like creative and product development, and then just general operations and management, like a kind of a general bucket. And then we obviously have a huge finance team. Our CFO's office is quite large, but that's because we have audited financials for our investors and things like that. Like, I don't think your average Amazon business needs that, but you definitely need the cash flow forecasting and things like that. But the key is, I think if you're going to replicate what we're doing, is all those functions are centralized for all of our brands. So like our marketing and advertising team manages it for all of our brands. Our supply chain orders for all of our brands. And then underneath we have the brand managers that are in their day to day, but they're kind of like monitoring, looking for growth opportunities, etc. And then they go up and ping kind of the core function, function experts, if you want to call it, to use his terminology.
Right.
And then the team, I mean, I think early on you're better off, just getting athletes into the business and to help you out and help you scale. And then I think once you reach a certain, figure out what your deficiencies are in running a business across those kind of core functionalities, and then I would, hire to those strengths of your weaknesses.
Right.
And then you can, once you scale up, you can take it from there.
Right. Awesome.
Good question, though.
Yeah, no, that's a great question. I actually had the same question earlier, but I just forgot to ask. So let's answer one last question here. So we'd love to get a better understanding of the valuation process. Do you guys use DCF or any other metrics? I know that you talked, on the surface level of what you guys look for in the product. So category leaders and review mode and stuff like that.
Yep.
But as much as you're comfortable in sharing, what are some of the things under the hood that you guys look for? Is it year-over-year growth? Is it profit margins? Like what are some of the things on the balance sheet or the income statement that's really attractive for you guys?
Yeah, definitely. Right. I think it's trends. So revenue trends are really important. And we tend to weight the nearer term a little bit more than the trailing 12. Right. So trying to taking seasonality out of the equation, obviously. So kind of what's your last quarter's numbers look like relative to the previous quarter, relative to the trailing 12 months. So if you're accelerating, that'll impact your valuation. But if you're decelerating, conversely, it will as well, right? Because then we're gonna have to invest and figure out, just dig a little deeper. Why are revenue trends decelerating? Is competition come in? Are you priced too high? Are you not running enough ads? Kind of all that stuff, and we try and figure out how we would get it back on the growth curve and what the capital investment for us would be to do that. And then, just as long as the margins are within the range, right? I mean, some things that we definitely look at is if your margins are too good, that's probably a little bit of a red flag to us. If you're running at net 40%, it probably tells me that over time your pricing is going to come down because people are going to exploit, and someone else is going to find that marketplace and exploit it. So that's why I think margins tend to settle into that 20-30% range. That's probably the biggest. And then maybe the other thing that we look at is definitely the ad spend. So, if in conjunction with your keyword ranking. So, something that would turn us off is you're spending 18% of revenue on advertising and you're not ranking very well for high volume keywords in your space.
Right.
So you're basically buying all your sales. Now we would make an assessment of, hey, can they get to the organic and can we drive it there? Maybe they're just not good at keyword optimization on the back end.
Right.
So that could be an opportunity for us, but then it's an assessment of the competitive landscape and say, okay, is there any reason why they couldn't get there with the kind of the asset, the listing it's as is today, or improvements we could make?
Makes sense. Yeah. I look at I guess when I look at an Amazon business, I take a look at where they're currently ranked out of all the keywords, right? So let's say that, for example, like an Amazon business right now, I'm selling this cup and it's ranking number 1 for the biggest keyword, but it's not ranking anywhere else for any other keywords.
Yeah.
That represents a huge opportunity, right? Because you can buy the business and rank, how to rank, you can throw your capital at it, rank that product. And by theory, your sales should go up as well. It's kind of so that makes a lot of sense. Actually, I want to ask one last question. This is a pretty short one, but I think it's very applicable to what is happening right now with the current pandemic in China. A lot of big companies are sourcing in other countries now, Vietnam and other Southeast Asia countries. From a supply chain perspective, are you guys diversifying your suppliers in terms of the countries of origin, or are you guys still kind of focused in China?
Yeah, it's a little bit out of my zone of competence, but we do get redundant suppliers for the majority of our products. We do have, supply chain set up globally. So we are sourcing from other countries outside of China. I think a lot of it has to do with expertise in specialties, right?
Right.
So like textiles, right, is kind of Pakistan's, leader of the pack in the textiles, for instance, or steel and metal products. I don't know, maybe that, I don't know if that's India or not. I don't recall, but I know like our team is constantly looking at that. And I mean, it can be interesting to see what happens. I think everybody now is like trying to go back to China because it's open again. Like it opened up first, right? So it's like this weird. It's like went down, and now everyone's like coming back to China because they're like kind of back to functioning again.
Right.
When everyone else is still shut down. So it'll be interesting to see what happens over time. And the U.S. So for the U.S. obviously anything that's like fluid based, et cetera, is here. So it's really product specific.
Yeah, that's right. Even in China, guys, for those who are listening right now, like different regions of China, they're experts of manufacturing different types of things.
Yeah.
So electronics, like you want to get that in Shenzhen, right? You don't want to go anywhere else for
Yeah.
that. Have you been to China, by the way?
No, I was actually looking at China Magic, and then all this stuff happened.
Darn.
Doing Canton Fair, yeah.
Yeah, I was supposed to go. I was supposed to go next week.
Yeah, I think that it's probably on my list for 2021.
Yeah,
I just want to go and experience it. And,
yeah, you have to.
I've heard amazing things, and
yeah,
I know a lot of our team's gone over there, but
yeah, I think you'll love it. So yeah, no, great. Okay, guys. Well, look, I appreciate everyone for hopping on the call, and more importantly, so I charged $20 ticket for this event, but more importantly, I wanted to use that money to actually make an impact. There's a lot of small business owners that are suffering right now, especially outside of the Amazon space, for example, restaurants and stuff like that. So I'm in Canada. I'm in BC right now, and the COVID, it's pretty decent. Like our hospitals are not overwhelmed or anything like that right now. And I said, hey, I wanted to donate the money to like healthy or to healthcare workers to get them proper PPE stuff. But I talked to some healthcare workers, and they actually said like they actually don't need it right now. So I thought maybe it's better in BC at least. Obviously in New York, that's a different story.
Yeah.
But I thought maybe I can actually use this money to support some local businesses somehow, whether it's just like write them a check or buy a lot of food from. I don't know. I have to figure that part out. But yeah, no, I appreciate everybody for hopping on the call. I hope that this call was super helpful. And for you, and I know there's a lot of linguos that was over your head, but you can watch this call again and just Google all the terms, right? What is DSP? What is all that? So you learn something new every day, and that's how you become better over time. So Ken, thank you very much, my friend. I'm really excited to see what you guys are up to this year, next year, and the future. And maybe I'll make a little mini version of Thrasio here in Vancouver.
Then we'll buy it. It'll be a great success story.
Yeah. Awesome. Okay, guys. Well, I hope everybody have a great day.
Thanks, Tom.
And thanks, Ken.
Yeah, everybody stay safe out there.
All right. Bye now.
Take care. Bye.